Well, you know what they say. When there's blood in the streets, NVIDIA is down 16% by midday. And that is exactly what has happened right now. So that long volatility trade that we put on in the last week's video about NVIDIA, that's up about 250% right now and should be closed out at this point if you're in that position. The reason I think it should be closed out is that we've won on two fronts here. Number one, the underlying stock has just moved significantly. The stock is down 16% as of the time of placing that trade. But number two is the level of implied volatility has increased by like 50%, meaning that we've won on Vega and on Gamma. And it's for that reason that we take our profits at this point and just close out the trade. But that still leaves the question, is there a trade to take on NVIDIA right now, given this new information and the recent move that we've seen? And that's what we're going to talk about in today's video. So with that being said, let's move over to the computer and talk about what the current data looks like. All right, so let's just take a quick look here at the core data for NVIDIA, right? We're down 16.58% today. We're up 65% in terms of where we were compared to Friday's level of implied volatility. The stock has just gotten absolutely crushed. People are panicking. And by the way, it is for good reason that people are panicking. This news that has come out around the AI for DeepSeek from China, this is big news because it's changed the way we think about the processing power needed to actually build these AI models. Perhaps we were a little bit over the top with how we evaluated some of this technology and the demand that there would be for them. So it caused some concern around that. And given the multiples that these companies were trading at, it makes sense to see a reduction in the overall price of these tickers. You'll see it across the board with any of these, chip companies, even SMCI and other companies of the nature are down significantly today. And we can see that right here reflected, right? So we've seen the level of implied vol go from 39 for the 10 days up to 79 points. That's a really big move. And that's why I don't think we want to be short volatility here anymore. The market is implying a lot of future movement. Coming over here and taking a look at the skew, which is basically the level of the implied volatility for out of the money puts versus out of the money calls. If we look at the 30-day skew, how it's changed over time, we can see that the skew has continued to increase in steepness. It's still relatively flat, meaning the market sees that the stock can still go up or down with the same degree of risk of it happening. But there is more put skew than there was on Friday for sure. But you can see the big change here between the two lines, right? Comparing 2 weeks ago versus today is the level change, right? That's everything that's happened here is actually a level change more than anything else. So coming over to the term structure, once again, we can see that really clearly displayed here. If we look at the longer dated options, we're seeing about a 5-point increase in volatility, which is actually not as high as we would have expected to see it. And maybe that's something we can take advantage of here. But looking at the shorter dated stuff, that's where you really see this massive spike. I think what this basically indicates to me is that the market is actually pricing this new information about the AI from China as an event. We're expecting to see a repricing in the short term based on this new information, a new valuation of these chip companies based on the impact that this new discovery that people could build models for so cheap is going to have on the market, right? Depending on the impact of that, we will see a reflection in the value of these companies. So with that being said, there may actually be a trade here where we can do something with the forward factor, which is currently at about 18 points for the 30-60. We could potentially structure a long calendar spread here. It's over that threshold we use for the calendar spread strategy at Predicting Alpha of 16 to 18 right now. And because it's so liquid, we could probably actually get in and out at that forward factor. But even if we don't want to do that, truthfully, we could be looking at selling some of this shorter dated volatility, maybe with a bit of a directional view here where we maybe sell some out of the money puts or do like a bull put spread. The stock's down huge today, right? So we see that increase in the out of the money puts. We see the level of vol go up. Even though there's a chance this thing continues to rally down, depending on what comes out about this model, or it continues to rally up if maybe the model is overstated, right? Maybe there's not so much truth coming out from what the Chinese are saying about this model. Any of these things are possible. But what we do know for a fact is that the level of vol in the short-dated contracts is getting back up towards the highs. We are well above the 75 percentile, and we are approaching the all-time highs that we see implied volatility at here. So looking at that, I would definitely be considering selling some of this shorter-dated volatility. I wouldn't be sizing up huge here. This is not like a bubble trade or, what we saw with GameStop or any companies like that. But there is room to be placing a trade here selling maybe a bull put spread in the shorter dated contracts, 10 DTE, probably before the earnings event is what I'd definitely be looking at. I wouldn't be touching these longer dated contracts because if you take a look, we're pretty much at the 75th percentile for these. The change that happened in those is quite small, just maybe 5 to 10 points at the most. If you did want to sell some longer dated vol, I would be looking at doing something around the 60-day mark. I wouldn't be going out any further than that. But that's not really too much of interest to me. If we had seen the back pick up more and maybe get up to that, like, let's see what the max is here, right? 60. So if we saw it get up to like 55 or, in maybe the 90s, if we see it get up to like 60, then I would be saying maybe we should be a seller of some of this longer dated volatility. But at 54 points, that's maybe fair value or slightly elevated. It's really the gamma in this shorter dated contracts that there might be some juice for us to squeeze. So if I were to be looking at a trade right now on this, I would no longer be long volatility. I would take that profit off the table and maybe open up some bull put spreads or something of that nature to take advantage of the increase in short-term volatility. The last thing you can do if you want another debit position is you can structure a 30-60 calendar spread. So you sell some 30-day contracts and you buy some of the 60-day contracts. Keep in mind, though, that you may have exposure to some of that earnings volatility, though, in those 30-day contracts, right? But that's pretty much it, everyone. If you enjoyed this video and this quick analysis on NVIDIA, please make sure to subscribe to the channel. If you want access to our data platform and you want to learn these boring strategies that actually make money, that we actually run as a community, feel free to take a free trial with us. The link is in the description. And yeah, if you're new to options, there's another link down there for you, which is everything I know structured into a free course for you. And you don't even need to give me your email for it. It's literally just a spreadsheet that I made. So feel free to check that out. Thanks so much, everyone, and we'll talk soon. Take care. Peace.